We started the show talking about the yen gaining versus the dollar more than 1%. Again, I've seen some commentary out there basically chalking this up to the interview Trump gave to Business Week, saying, look, the yuan and the yen are unfairly weak, and of course we want a weaker dollar, so on and so forth. How much do you look at that and say, yeah, there's a little bit of politics in the yen this morning?
We've been highlighting that since the intervention last week. I think an interesting part is people look at intervention and you need a fundamental misalignment. It needs to be kind of short term and the markets need to be orderly. Essentially, the Japanese officials coming in and intervening in the yen when the dollar's already declining. Our models, which the short-term ones kind of were great at explaining prior intervention, showed no dislocation. They're actually telling you dollar yen should be higher. One thing that we saw is our positioning indicators were max short. So, maybe there's some point there that you want to squeeze people out of the market, catch them off guard, especially when everyone's in a one-sided trade. But I agree with you that I think political economy, we're calling it kind of Japan Inc. Japan Inc. being the government, the central bank, and the pension funds. Those are all the big drivers of yen. And you could argue the policies that have been put in place in Japan over the last 10 years or so has been one where it's low real interest rates. It's essentially capital flows being pushed out of Japan on an unhedged basis by pension funds, which are buying foreign assets, particularly equities and fixed income. And again, the BOJ has just allowed this to continue. So I think a big part of this is an institutional move by the entire country, by all the people who drive the currency. The government, the pension funds, and the central bank are all kind of moving in the same direction. We think the BOJ is going to hike. We've been saying it all year that they are going to hike more than the market's expecting. And the yen is now responding to this because I believe that the one thing that I think China and Japan and other Asian currencies are worried about, and they should be because they are the most undervalued on our models, is they're worried about getting a tariff target on their back. And Japan in particular, it's the one currency it's probably, depending on your model, could be 50 to 70% undervalued. So I don't see, we see like longer term, yen, renminbi, these currencies should be stronger. Yen is more immediately. I do think the renminbi, something we can talk about another time, should be stronger 2 to 3 years out. But right now, to me, the trade is, we've been telling clients to be short euro, yen,
Mark,
on policy
can I
divergence.
Just quickly here, because we're about out of time, but on this idea that, again, part of it is they want to get it out ahead of tariffs if Trump looks at them and says your currency are unduly weak and that sort of thing. Does that mean we're kind of talking about policy errors, that tightening more, or in the case of Europe, maybe not cutting as much because they're worried about that geopolitical element?
I think in Japan, there's room to go. Like if you think about just how undervalued the yen is, some tightening of financial conditions in Japan is not going to have a massive impact on the economy. And again, some of the indicators that we track, if you look at inflation, and again, the key thing that they were trying to do in Japan was get higher inflation to pass through the nominal wages. So they have succeeded at that. It's just that the BOJ has been kind of slow. They've been a bit sluggish in terms of moving forward. But to me, the conditions are in place for the BOJ to hike without having a massive impact on the market, and a stronger yen is not really going to have a dramatic impact on the economy when it comes to growth. So I think that's one where you could say they're behind the curve and there's a lot of room for policy moves.